Good morning. So overnight, obviously we moved down a little bit further, and I think our entry point was at 73.67 long, 73.67, 73.76, and now we are from that point, like 50 ticks lower. So the profit loss is showing that. Um, This wasn't the best entry looking back, and I'm going to show you why. One, we didn't really measure this right. Uh, 67 was less than $1 away, okay, from the previous high. And really, you like to see numbers like 120, 138, 150. See that? 150 is a good number. And you typically see these reversals happening around those numbers like 120, 130, 150, 160. Rarely do you have anything beyond 160 as a reversal point. And one tool that really helps with that is the mean reversion channel. Okay. And what the mean reversion channel, it's a beautiful tool. What the mean reversion channel is doing is measuring the highs and lows, in this case over the last 5 days. So it's taking that high, this high, and it's saying, going forward, it's saying, this is, um, from those highs and lows, it first calculates a mean. Okay, so this is the mean. And then from there, it can extrapolate the plus and minus one standard deviation and plus and minus two standard deviations. So, typically when you see price getting in the negative one standard deviation or plus one standard deviation, that's when things are extreme and the price is, ready to reverse. So this is really a much more precise and mathematical tool for trying to identify oversold, overbought, instead of relying on a CCI, which is more of a qualitative tool. This is more of a quantitative tool. So um, last entry long really should have been here at 63.55. See? And so we were about 20 points off, and we could have had our limit order sitting right here so that when the market comes at us, we just instantly get taken into the trade long, and then we could have had our stop loss below the 12 period moving average, which is what I like. So ideally, we should have done this, risking $1.50, right? And um, basically trying to get $1 move out of that. So it's a good way to take, it's a statistical way of measuring volatility in the context of over X day period. So in this case, we're looking at a 15, 5 day, or you could take it out to 10 days, So over the last 10 days, it's measuring those highs and lows. And again, we're in the negative one standard deviation level. So this is really the entry we should have waited for. We were in a little too early, there. And the other thing I typically do with this is I will add the daily high and low. The daily high and low. Why is that? Because typically, it's a measure. It gives me some more context, and I think you could really just, you could literally do very well with just this. You could, if you're going short, you don't say if you're thinking, okay, I want to take a short entry trade, and this was the last short entry. So you're measuring from the previous low, and you had a 132 move.
It's 8:30.
So prices, really extended, and lo and behold, boom, it fell back, back to the other end of things. So you would, in this trade, you would have been 132 to get above the positive 1 standard deviation, and you could have put your risk out here. I don't like counter trending. I'm just not used to that yet. But you could put your stop out here for a 54 tick risk. And then waited for the move to get to the other side of the channel, and you would have had $1.12 gain from that 50 tick risk. So that's a good, that's a great risk to reward there. So now is a good time to go long. Great time to go long. You are 140 from the previous high. Good number. You are in the -1 standard deviation level, and you are $1 away from risk if you want to go to the 12-hour. If you want to just, play off of the 3rd standard deviation level, you're risking 51. So you're risking 51 to get a possible dollar move. If you get back up to +1, that's $1.14. It's a different way of looking at the market. I've found it to be super accurate, and I don't, it takes a lot of the guesswork out of finding where the entry is and where the exit should be. And it's just, I love volatility, and it's measuring volatility. It's a volatility. It's a quantifying tool of volatility. Super accurate. And when you use that with your overall context, that's when it gets powerful. Like, this is a great entry, one, because momentum is on the upside. So, if you waited for this entry now, this is more, more probabilities are stacked in your favor. Okay, I'll leave it right there, and we'll review at the end of the day and see how things wrap up.